You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and it's 12/8/21. Well, there is opportunity in opportunity zones. Yes, you may be thinking the whole world is an opportunity zone, but there are opportunities, and then there are opportunities. Ashley Tison's on with us right now. Ashley, opportunity zones. I think before we get into the discussion of how good an opportunity they are, we need to really understand what they are. And hey, if you want to find out more about Ashley's business, what he's doing, ozpros.com. And if you got a question for Ashley, send us an email to kl@kerrylutz.com. Ashley, what is an opportunity zone?
So opportunity zones were created by the Tax Cut and Jobs Act of 2017. And effectively, it was done to spur economic investment into areas, historically underinvested areas. So the legislature allowed the governors to designate up to 25% of their low-income census tracts, and it effectively it created 8,700 of these across the United States and in the territories, Puerto Rico, Guam, and other U.S. territories. And within an opportunity zone, if you have a long-term or short-term capital gain and you put that into a qualified opportunity fund within 180 days of that gain, then you get to defer those taxes on that gain until 2026. If you've invested in that fund for 5 years prior to December 31st, 2026, you get a 10% reduction on the capital gains when you have to pay them in 2027. And then if that weren't good enough, we got a batch of Jinsu knives as well.
Ah.
The third benefit that's available is that there is a step up in basis to fair market value after you've held your interest for 10 years. And so what that means is that after you've held your fund investment, whatever asset that fund owns is going to get a step up in basis to fair market value. And that's significant because it not only eliminates capital gains, but it also eliminates depreciation recapture. So what opportunity zones have become is an avenue for people that have capital gains to be able to defer those gains and effectively get an interest-free, or actually a negative interest loan from the government, because they're paying you to put your money to work in an area that's going to ultimately go up in value. And then on the back end of that, after a 10-year hold, you get to take out your investment and the growth of that investment tax-free. Meanwhile, if you're invested in anything that's got depreciation that you can use to offset the income, you're also not going to take any depreciation recapture. So opportunity zones have become a really, really powerful tool for generational wealth building.
All right. And so that means that if you've got a property, really you got a huge profit on, and you had depreciation recapture on it as well. And if you don't know what depreciation recapture is, it's a really simple concept. As you own a property and the government allows you to depreciate it, when you sell, you basically have to recapture the depreciation, and that you wind up paying taxes on. So effectively, it's kind of like a 1031 exchange without the 1031.
Yeah, it's interesting because when I first heard about this, I was actually sitting in a CLE where I was learning about helping business owners mitigate taxes and put more of their money in their pocket when they sold. And there was a gentleman that was after lunch, and he was giving an update on the Tax Cut and Jobs Act. And it was about a 2-hour presentation, and he was going into the nuances and the intricacies of it. And it was like everybody was asleep in the audience. And then he started talking about opportunity zones, and I kind of perked up. And I ran him down in the hallway afterwards. And I was like, hey, that sounded like 1031 and private equity got married. And he's like, oh yeah. And they had a beautiful baby named Opportunity Zones. So I went back in, I started taking down domains and basically kind of launched into doing nothing but Opportunity Zones ever since. And it's specifically because you get a lot of the benefits and then some of 1031, but it doesn't have anywhere near the kind of complexity hoops that you have to jump through, because in order to create an opportunity fund, it's just a partnership that's taxed, or an LLC that's taxed as a partnership. And you self-certify with a fairly simple form process. And it made it so that folks can take advantage of being able to defer and ultimately eliminate taxes in real estate deals, but also in operating business deals as well. And so that's one of the reasons why I was really interested in jumping into it.
Okay. So one thing I want to get straight, this only applies to capital gains, doesn't apply to operating profits of ongoing businesses. Do I have that correct?
Yeah. So you have to have a capital gain as your equity that you put into the deal to start with. So you can't defer after-tax dollars or pre-income tax dollars. And you also cannot defer depreciation recapture dollars, because the IRS treats that as ordinary income, because you've deducted it against ordinary income as you've taken the depreciation. But what it allows you to do is to take capital gains and you can use that as seed money. And if you need to bring in non-capital gains money, you can do that in the form of a loan to the deal, and then ultimately to exit back end without any taxes whatsoever.
So you can actually put in more than your capital gain if it's a really good deal. And then when you eventually have your exit, you won't pay any capital gains on that either.
Correct.
Okay, interesting. So there's funds that you can invest in that you just take your earnings from a deal, from an asset sale, and you can just put it in there?
That's correct. So there's a number of kind of institutional funds and retail funds that are out there. Opportunity DB, that's the opportunitydatabase.com, has a listing of all of the funds that are out there. And you research them there. And then you can also create what we call a captive QOF, where you basically create your own. And you've got to do the compliance and you got to do the accounting and that kind of thing, but you can absolutely do these deals yourself. And I've had a lot of people say, okay, well, what's the threshold of gain that I need to have in order to justify this? And I walk them through that. I say, listen, it's not about the gain that you're going to have right now. It's about the gain that you think you're going to have down the road, because that's what we're really mitigating. And so if you run the numbers on like how much it's probably going to cost to administer this thing and that kind of drill, at current capital gains rates, if you're going to make more than $150,000 in 10 years from the appreciation of whatever it is that you're doing, it absolutely makes sense to do it as an opportunity zone deal if you can, if it's in an opportunity zone.
All right. So the types of investments that are covered, obviously real estate, commercial, and residential. I guess you could start a business in an opportunity zone and then sell it off in 10 years. And can you take an existing business and move it into an opportunity zone, or how does that work?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita Copper-Gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Absolutely. So we do it all day, every day, where we're working with existing business owners that are either making acquisitions or they've sold one business and then they're going to start another one. And we take their capital gains from the sale and we roll it into a new company. And then you gotta hit 5 tests, and the tests are actually not that difficult to hit if you're not tied to specific locations that are outside opportunity zones. The other piece is that so 70% of your tangible property has to be what's called qualified opportunity zone business property, which means that it's in a zone and that it's either new use or you've substantially improved it. But 50% of your business needs to come from active conduct in an opportunity zone. And the way they test that is by 50% of your employees working in the zone, or like 50% of the comp that you pay to employees goes to people that are working in an opportunity zone. So the ones that don't work it's more, I kind of apropos to ask, okay, what doesn't work that you can move into a business as opposed to what does? And the ones that don't work are stuff that's got, locations that you need to have outside of the opportunity zone. That's going to be tough. Or if you've got a really diversified workforce that's all over the place and there's no way that you could get them to come to an opportunity zone, which a lot of times they can actually do after they do some analysis, because you can get co-working space in an opportunity zone that's close to them. And they don't have to be in the same zone. They can be in any zone all around the country. And then the third one are kind of more like financial services companies that require an extensive amount of cash or financial resources that you got to keep in a bank account, because the IRS in issuing the regulations said that you can't hold more than 5% non-qualified financial property, which is cash, stocks, bonds, forward contracts, that kind of thing. So you can't create a financial services company, move it into the zone, and not pay taxes.
All right. And that's understandable. And New York had these opportunity zones for years, and there were all sorts of abuses that you couldn't believe, like Buffalo was an opportunity zone, Schenectady, and all these businesses moved there, and it avoided state tax, but its ultimate effectiveness was really questionable. So what if you have a business with no employees?
Well, I mean, technically you are an employee if you're taking money out as a guaranteed payment. And if you want, you could treat that. And so you would just need to work 50% of the time in an opportunity zone and you're good to go.
All right. And one thing we got to note is opportunity zone doesn't equal war zone, right?
That's right. So there's some that are tough, and rightfully so, because they're trying to attract investment to turn the area around. But there's lots of them that are, that you roll down through them. You're like, wow, I can't believe that this is an opportunity zone. And, I think that that's the key, is that, it's all real estate is local, right? And so each one's kind of vary depending on, what the local demographics are and that kind of thing. But there are lots of fantastic ones. And then the great thing about the program is that the ones that aren't so great, they're becoming better because of the program. That's
a good thing. Yeah, I think a lot of places in Florida, you'd be surprised, are opportunity zones that you wouldn't expect them to be. There was a lot of politics that went in on setting the opportunity zones, because the governors of the states were allowed to pick and choose a certain portion of them. And then others, I think you said 25% the governor of the state could choose, and the other 75 is a formula.
Well, it was actually the 25%. They got to designate 25% of their low income census tracts. And so some governors got their local county developers and economic development teams involved. And I think that some of them kind of were more random in how they selected them. Or if the counties didn't, get the stuff in fast enough that they missed out. And unfortunately, it was a really quick timeline that Congress gave the governors to designate. And so there wasn't a lot of information out there. And so I think the political machinations about some of the corruption type stuff that I think that we would see now, if that happened again, didn't happen on the front end, because people didn't really understand the extent of the program. And so when they originally designated them, I think that they went and they said, okay, which of these areas do we really want to try and beef up? Which of these areas need it? Which of these areas are likely to get investment? And where do we want kind of growth to happen? And I think that as a lion's share, a lot of the governors were very thoughtful about it and did a great job of picking the zones.
Well, what's really interesting about this, Ashley, I remember Milton Friedman decades ago talking about opportunity zones. And that's a brilliant idea. And you mentioned during the Clinton administration, they tried to get it through. But, Washington being Washington, Congress being Congress, couldn't get it done. And then under the last administration that will go nameless, because for obvious reasons, 30 years ago, I remember Milton Friedman mentioning this, 30 years ago. And now in 2017, I guess it was.
That's correct.
That's when it finally passed. Amazing what could be done if there's just a little bit of political will. Ashley, people are going to want to find out more about you. You're going to want to contact Ashley. You want to meet with him on the internet. What's the best way to do this?
Yeah, so if you go to our website at ozpros.com, we've got information about opportunity zones. I've got a downloadable opportunity zone cheat sheet. It kind of has a one page on opportunity zones. I think is very helpful. And then we've also got a number of videos that explain how the process goes and gets more into depth on to, some of the ins and the outs and the nuances. And the best thing to do is to set up a strategy call. So I talk to people from around the country on a regular basis, and I've had over 700 of those. And we've set up over 700 entities now that are opportunity fund entities. And we're passionate about helping put this really, really powerful tax legislation, arguably the best one that Congress has ever created, into the hands of Main Street America, where people can use it for financial freedom and for preserving the assets that they've worked so hard to generate. So that's our thing. And we'd love to get on a call to see if we can help.
All right. And I can envision, I'm a recovering attorney myself.
Oh, no.
Envision using trusts with this to great effect. And for estate planning purposes, asset protection purposes, and tax mitigation purposes, I can see using trusts with this to really supercharge it and get way more bang for your buck than you ever thought possible. Hey, if you got a question for Ashley, just shoot me an email, kl@kerrylutz.com. Tax mitigation, legal tax mitigation, something we are very passionate about, just like Ashley. And if you can do some good while cutting your own taxes, then it's a win-win for everybody, including the government. We don't need to get into that, though. Ashley, great to have you on the show. Good luck, and we will definitely have you back.
Thanks, Kerry. Really appreciate it.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.